So once again, this is only for learning purposes. Let me take you through the model. This is the cover page, and here you can see what we call the model cell style guide, and this is just giving you explanation as to any cell you see in this particular format, basically telling you that they are input cell. The second one, see it's colored in this format, they are historical, and every other thing they are more of formula. And here we have the content of the model, extracts, input section, calculation section, output section, and also data sources section. Under extract, you can see the historical financials. Under input, we have assumptions, input, and scenario calculation. Also, we have our WACC computation, weighted average cost of capital. Under output, we have a summary, income statement, balance sheet, cash flow, the DCF valuation and analysis. So this is only DCF income approach valuation. I've not incorporated market approach. So on your own, maybe you can learn that some other time. Then the data sources, ERP, equity risk premium, beta and industry beta, US yield, historical share price, then the data extract. And I've created more like a menu button, so on each page it's easy for you to navigate to any worksheet. So from here, if I click on it, I'll go to my summary, and here this is my summary. Should I call this summary or dashboard? Mm, I know there's difference between summary and dashboard, but let me call this summary, and this is to just give an overview of the valuation model that I've done. Just said hop here, you can always move navigate by clicking on this option to see the list of all the worksheets for navigation purposes. We have different cases, I think up to 10 different cases, and they are split into two as well. So I'm going to show you that one when we get to the scenario inputs, where you can select to create a different scenario for assumptions inputs, and you also have the same thing for other line items specifically. A good one. So when you are building a valuation or building a corporate finance model, some things you need to look out for. One, especially if it's a mature business, you definitely need to look at the historical and also look at the forecast, right? Don't know why I've called this budget. It's supposed to be forecast, by the way. Let me change that. Okay. Now, because it's a mature company, you expect more like a steady growth. They are at the level of maturity. So at times seeing something like a double digit growth, right? Especially if it's something above 30, 40 for a mature company in a mature economy as well. So remember that mature economy, not like this emerging market where their inflation just keep flying up and down. And so you definitely might be seeing that, but for a typical developed market, you hardly see something like that, right? You hardly see double, even if it's entering doubles, always less than 30, less than 40. Okay, so here the historical on average from 2020 to 2024. So FYA, A means actual, FY means financial year. And you can see the forecast from 2024 to FY 2029. So I think their own calendar is from, I think that should be, they're using January as their, yeah, I'm correct. I'm correct. So you can see, okay, yes. So 1st February to January, that's their own calendar year. Okay, so revenue past 5 years and looking at what we are the forward forecasts on average, compound annual growth rate, so which is the CAGR, 5.5, cost of sales also 5.6, and we're saying forecast is a little bit lower. As I said, please, this is only for learning purposes, right? And I said I will make this available so in case you want to use this for your own decision making, investments, and all those things. Yes, you can always update the model. It's very flexible. So SGN here, historically uh, 5.1 and forward looking 5.9, which is slightly higher. So many factors, but as I said, only for learning purposes. Then EBITDA, historical 5.3, then forecast go with something lower 4.8 on average, which is the compound annual growth rate. I'm sure so many factors are we've considered so many factors in getting that. So operating income, operating profits, historically compound annual growth rate of the operating profit 7.1, and going forward slightly lower. As I said, many factors being considered. Let's leave it to you to also do your homework. Now, average revenue growth 5 years historically 4.8. We believe they should be able to do better than that coming 5 years. The gross profits kind of maintain the same thing. EBITDA margin slightly lower, and I think that's driven by expected increase in inflation and some other variable that we've considered. Operating income, we feel the next 5 years might still on average maintain the same thing. Profit before tax, then net profits. For the return on assets, we feel they need to be more efficient with the assets. So coming the forward years, they might get something higher. The same thing, return on equity, being able to use debt to to increase the return, also return on capital employed, slightly expected to be higher. Receivables, the same. Inventory days, we've reduced that. I believe they should be able to do too many discounts, many things to be able to sell more, right? And get their inventory out of the stock as soon as possible. Accounts payable are slightly lower. They should be able to manage their cash cycle just the same way they've been doing it historically. And here, if you look at the upper bottom here, up here, so you can see the valuation, enterprise value, equity value, and giving us this share price. And now, please note that valuation is always at a point in time. And as I said, this is only for learning purposes. So what I've done is I'm valuing this as at 31st January 2024. So which means anytime you are doing valuation, you always stand at a point, and it is only the data you can get as at that exact valuation date that should be incorporated. As I said, learning purposes, and that's why I've decided to take this back as far as 31st January 2024. So which means what I've done is I went online to also check what was their share price as at 31st January 2024, and this is what I got. Okay, and then my model is saying 58.7, and the decision is buy, right? Which means it's currently undervalued, right? And I think as at today, interesting thing, their share price is even, I think, so the share price I extracted, so which means as at August 30, 2024, their share price was 76.44. So which means definitely this was right, that as at that period the uh, the company was undervalued, right? And more expectation, we expect them to even perform, to outperform what we've incorporated. So the WACC used is 8.1. I'll also show you how we've computed that. Then cost of equity, and then we have the terminal growth that we factor into the valuation computation. Now, just to see everything at a glance, the past 3 years actual, this is what they've done, and this is what the forecast just kind of look like. So it's easy for us to be able to look at what is happening, what has happened in the past, and how do we expect them to move. You can also see the key performance indicator right at a glance. So this is how you also look at your model and be able to say that yes, I think this is reasonable, this is not reasonable. So you can look at the revenue growth, uh, 6.2. So even past 2 years they've done 6.76, and said yes, we expect them to be able to do more. But I know no business grow on a straight line growth rates. Say it's 10% next year, 12%, and that year 15%. So no, there's growth, but it's not always like that. So most times it's always like a zigzag thing. They'll feel they will be able to perform very well, and considering they're also mature uh, firm. So EBITDA margin slightly lower than what they even did in 2024 and 2022. However, I kind of feel comfortable. Net operating profit after tax margin slightly lower than what they've even done in the past 3 years. But I said it's for learning purposes only. Then their net working capital to revenue and their free cash flow to revenue. So which means at a glance, it's easy for you to see what's the computation of the valuation. And I also added some interesting charts to just kind of see what's the historical trend, what's our own forecast position. So revenue growth, you can see that revenue growth. The dotted one is represent the forecast period. So you can see the EBITDA margin. Okay, you can also see the net profit margin. So you can see the net profit margin. You can also see the return on capital employed, see the return on equity, and also the return on assets at a glance. So these are more like the main core data needed for my summary to be able to make those decisions. And here I have based on my different cases. So if I go to case two, all right, you kind of see what still happens. So case two is even telling me that you know what, still buy it. It is way higher than the what it was selling as at that period. Case three is telling me that I should sell. So each of the case has what we factored in, and you can also uh, do your own based on what you expect or what you perceive might happen. So if I go to case four is telling me that I should still sell. Case five, right? So when it comes to corporate uh, business, right, they are very sensitive to so many things. So that's why when you are doing evaluation, we try as much as possible to try different scenario, different cases to see what would be, what would not be. So if I go to case six is also saying I should do what, I should still buy cases. So those different cases, right, just for you to make a decision, look at how sensitive they are. It could be maybe a 5% increase in WACC. How will that affect the business? 10% increase in cost of equity. How will that affect? So those are minor things that can really affect the business. Now let me walk you through the main thing. So here we have the historical financials which we've extracted uh, as presented in their audited financial statements, or the income statement, the balance sheet, and also the cash flow. We've extracted it the way we have it in the historical financials, and straight to the inputs So this is where we have the model timing, right? The valuation dates and model currency. This is just splitting out our period. As I said, their FY is from February to January, so they are not using January to December as we all think might be. So their own FY always starts in January. Okay, in February. Here we have the drivers. As I said, I'm going to make this file available, right, so that you can also use this, and please only for learning purposes only. I might be wrong, I might be right, you might have different perception, uh, and that's why it is finance. It's dynamic, right? Your view might be valid, my view might not be valid, my view might be valid, yours might not be valid. So it's just only for learning purposes and how you perceive, right, or your understanding of the industry as well. Here we have our revenue, we have our cost of sales, SG&A, the stated the driver as well, revenue, year-on-year growth, cost of sales percent of revenue, SG&A percent of revenue, interest as percent of financial liability, which include their interest on debt, interest of finance list, then interest income on cash deposit. Then they also have some other line item which we've considered: profit before tax as percent of profits, provision for income tax as percent of profit before tax, and then we have the outstanding shares. Also on the balance sheet side, you can see receivable days, inventory days, prepaid expenses days. So I've also structured it the same way we have it in the financial statement. So each line item comes after each other, so it's easy for you to be able to trace what we've used in forecasting what and what. So PPE, I kind of use revenue to PPE to revenue multiple, more like the ending balance. Then look at the capex as percent of revenue, operating leases, the changes, goodwill, accounts payable. So we've created each driver, as I said, and that's one thing about corporate finance. Line item can have more than one or two uh, approach that you can use in arriving at the figures that you want, right? As long as it's reasonable and it makes sense and you can defend it, right? Just kind of makes sense. As I said, we've created three different scenario. So what we have currently here is like the selected case. So if I zoom out, you can see selected case, which is base case. So here you can see the base case. So here you can see all the assumptions on that base case. where you can just decide to uh, do updates, do make any changes you want on that base case. So this is best case, and also this is worst case. So maybe in case you want to add some other cases, we can add them to it, right? But I think every other thing is more of the same. I'll only change the revenue, because revenue seems to be driving every most of the core line item. As I said, you can always make adjustment. They are all input. Okay, then this just kind of help us to pick uh, based on the scenario selected, brings this under this particular column, and that's what feed into our model calculation. Okay, and now to the scenario, to the scenario. This is more like what we call a typical mega scenario. Here we have our input assumptions. So which means under case one, which I'm saying this is my base case, my base assumption based on what I'm using. Okay, so base case, I'm saying input should go with, let's go with base case. My sensitizing of other line item, for example, revenue, I'm saying leave it the way we have it. Cost of sales, SG&A, leave it the way we have it. Net working capital, leave everything. Also consider our capex and also our WACC. So these are more like the core key line item I feel has influence or effect on our business valuation. Now for case two is saying that I can decide to name it, right? Decide to name it, I can say revenue growth with increase in net working capital. So if I put this, so revenue growth with increase in net working capital, right? So then that becomes case two. Okay, then um, also with best with our best case assumptions. So you can put your notes just for them to be able to understand what that scenario is saying. So if I come to my, let's assume I'm selecting case two, okay, and I come to my summary. So you see that my summary is telling me model scenario case two. Do that out, case two, right, with revenue growth with increase in net working capital with best case assumption, and assumption input is telling us that yes, that is the best case, right? So that just kind of make it easy to read. I think you also have that on each worksheet. So right, yeah, so you have it on each worksheet to also be able to see the current running scenario. Okay, so under that we are saying, you know what, we are sensitizing revenue, we are increasing revenue by 10% across our forecast period. Receivables should, the days should be up by 5%, inventory days by 5%, prepaid, leave that out. Accounts payables by up by 5%, accrued liability up by 5%, and we're keeping capex the same. Now, if you come under case 5, you can see case 5, we are increasing revenue by 20%. I would say because that is increasing, then definitely there should be a need for us to also invest in our capex PPE, right? While accounts payable and accounts receivable is increasing, and SGN is also increasing. So you can create those different scenarios, and you can see if you come under case 7, 5, this is just saying 5% increase in our WACC. Okay, so that's case 7, right? So if I come to my summary and I click on case 7 to look at what I have, so I said mature entity are always sensitive to changes in some macro data, right? So now I work at 8.1%. So if we say we increase that by 5%, add additional 5% to it, I think that should be something like 0.5 or so. So case 7, then that becomes 8.5%, and it's just telling us that hey, that guy just sell, don't buy. Okay, then if we put it back to our base work, which is 8.1, it's telling us everything is looking good. So this scenario is very important, especially when you are trying to make different decision, look at what could play out here. So we have our calculation properly laid out, right, and it's easy for you to also make switches. Now this is a kind of dynamic, so which means if you decide to change the date, there are some, so if you change the dates, right, maybe the actual then move to this period, then this become forecast, the calculation kind of also automatically updates, but you need to update your input. So that's more like one of the dynamism I've incorporated into this. So you can take a look at how we've done all the calculations, created schedule for each of the line item. And here under my work computation, our computation. You can see risk-free. I've considered beta coefficients on level beta, which is using the Modaron's data as well for the market, and debt to equity ratio. We've also used the industry average. The marginal tax rate we've considered was the historical marginal average, and that's what I've used there because they kind of operates across different locations, different countries. So right, so what I have to do is just look at what the marginal tax rates they've had historically and just bring in the average equity premium, considering they are already established mature listed company. So size premium and firm specific premium really does not apply. That gives us our cost of equity. Then our post tax uh, debt rate, right? This is what we have. Then our equity to capital debt to then that we use that in computing our WACC, which was used in our valuation. Now to the financial forecast, this is where we have it. So historically, I decided to extract the past 5 years historical financials, and also based on that, also doing the forecast as well. So when you are building corporate model, you just need to be very, very realistic. Revenue does not jump like that. As I said, especially we are building for company that is in a developed market. All right. So if you take a look at the total revenue, so year one, uh, historically 2020, 21, 22, the kind of they're within a range of revenue, right? And that just kind of tell you the concept of being in mature market. I can see revenue growth just single digits. Then 23, 22, they've also maintained that another range, and I feel they must still continue that range over the next 3 years. Okay, then another year comes in like that. So just as I said, consider so many things. Cost of sales, SG&A, also kind of mirror what they've had in this historically. Include the EBITDA margin. You just need to make it very, very realistic and what is achievable. Okay, then you have your net profits. You also look at what's so you look at the margin, you also look at the figures as well as to does it make sense? Do you think this can be achieved? All right, so also the outstanding shares. So I've decided not to touch the share part of it. They've been having a lot of shares buyback and all those things. So I've decided to limit this and not include anything in regards to that. As I said, this is only for learning purposes. If you want to know more about share buyback, how you do that, you can. I think you can also go online and do further learning around that. Okay, if you look at their total assets, right, so as much as revenue is important, you look at the trend, also look at the balance sheet trend as well over the period. It seems they've been within a specific range, right, and going forward this is what this kind of look like. As I did like a balance sheet structure analysis as well, so we're going to see that when we get to the analysis. Their liabilities, also look at the what the total liabilities kind of look like, and then you have the equity. So the consolidated cash flow, I don't usually use the historical cash flow, but in this case I've decided to also import the historical cash flow, and also that's kind of help us look at what the trend also look like historical. As I said, I've not considered share buyback, but they have made some assumptions around it, but as I said, I've not considered it, I've not modeled it out appropriately like we normally do. Right, and here we have the cash flow, and also check that with what the historical cash flow, what that has made. Then included in some other reports, total capital employed, the net working capital, right? Also calculation of the changes. There's difference between net working capital and there's difference between working capital. So you can also see that. Then I've computed my net debt. Now for the net debt, we when that the valuation of it most times is always dynamic. So we have more like this valuation balance sheet structure that we use, and we're saying, hey, everything in the balance sheet must hit your valuation one way or the other. All right, and this, I think I'm using that second approach. Typically, when we want to really dive into it, things like deferred income, like this, right, you definitely need to find a way to break it down, do some adjustments. These are accrued income taxes. You also need to make those adjustments, considering the business will grow into perpetuity. Are you saying they will keep owing debt, they will keep owing tax? So there are so many adjustments, but as I said, I've left those adjustments out and keeping this very, very basic, right? And from there, we completed our work. Completed our work, right? So revenue. So I don't know. I love having my free cash flow from the top, like revenue. Have your cost of sales up to your no part, then do those adjustments to when you get to your total free cash flow. It just kind of give me this good, this kind of good story about the business, right? And also to say, am I am I doing something wrong here or something like that? Then you can see the historical compound annual growth rate and also the forecast compound annual growth rate. Okay, terminal value. Had to compute the terminal value using this. So what I had to do was to use the last 5 years revenue CAGR. So from 2019 to 2024 was their CAGR, and I kind of feel comfortable with the value to get my terminal value. I also had to adjust that for a mid-period adjustment, apply my discount factor to get my present value of my total cash flow, and I have my enterprise value. Net debt kind of coming as positive. They have more cash, more assets. Okay, equity value divided by the outstanding to get our share price. And as at that date, I said the share price as at 31st January 24 was 55.9. I think they've even done more than that as at today that I'm recording this video. And here you have the other key performance indicator just to help you keep track either you are making sense or not. And here we have our sensitivity table to also see different valuation range. Right, as at 31st January, I was getting something at the high of 80, right, of average of 60. And as I said, the historical share price as at August 30 was already 76. So kind of look good. Okay, then we do a few analysis to look at if this kind of align with what they've been doing historically, your profitability, your return, your efficiency. Then I also did like a common size, doing using everything, both income statement and balance sheet, as a percent of your revenue, and that's also kind of give you a sense of the trend of historical, and is your forecast kind of aligned with that. Okay, and I think I did the other one where you do everything as a percent of total assets, everything as a percent of total assets, and here for the income statement, and you can see this, which is also a very good way when you're trying to get your assumption. Historically, their revenue to total assets multiple, just they've been within this range of 2.2 and above. All right, and that's the same thing we've also factor in historically going forward. This just kind of give you a sense of to be able to see the trend. So the same thing, every line item in the balance sheet as percent of total assets, and just kind of give you a very good structure. To my data sources, ARP, this was downloaded from Damodaron, our website, and a big thanks to him for always making this data available. Industry beta, the global one. I decided to use the global one considering the business operates in different region. So US yield, right, as at that period, which I used for my risk-free rates. Okay, then the historical share price of the business, as I said, as at 30 January, right? So January 30th, I think it was selling around 50. Okay, yeah, so 55 on the high, 55 open and close at 55.20. Okay, they said my valuation is saying it's currently undervalued, so which means if I've decided to go ahead with the share price as at 30 August, it was already 76.44, right? So close at 77.23, which means I've actually made a gain. Okay, then this is where I just have my data extra. So in case you are wondering how I've been able to create those charts, this is well, this is where they are all coming from, and you can take a look at it. So in case maybe you want to create that kind of charts, right, you can use this, and this is just like a blank worksheet. Once again, if we go back to our summary, Now you can now understand the outflow of the model, alright, and be able to look what we have. Alright, as I said, from here it's easy for me to navigate to any part of the model to be able to see what I've done. Okay, so once again, my name is Victor Okundele, and this is just my valuation walkthrough using Walmart as a case study. Please note that this is only for learning purposes and no decision should be made based on this. As I said, I will make this uh, documents available so that you can also use this for your own personal in Z. Always try as much as possible to rebuild your own from scratch. Yes, that's the best way to kind of learn modeling and evaluation. So once again, thank you.